Hi everyone, welcome to today's video. So today I have a very important topic that I want to cover with you. It is around bond investing. Before you drop off, hear this sentence out. So the sentence is that you can actually make up to 100% returns by doing fixed deposits. How? I'm going to explain this on this video. So please watch the video till the very end. Only then it will make sense. So the primary objective of shooting this video is that you will hear people talking about, hey, you can make like 100% return, it's completely safe, you can go and invest in bonds. That is just a fallacy. It is not the complete picture. Yes, people can make up to 100% returns by doing fixed deposits. I will explain you as I have promised, but there are a lot of nuances that go into the picture. So let me demonstrate this point by sharing a short anecdote with you. So the anecdote is about my mother-in-law. I did a video with her on her investment journey so far, so you can watch it here somewhere. It's a very interesting video, got a lot of positive feedback on it, so go watch it. One of the key points that we captured through that discussion was regarding the investment she made in DHFL. So DHFL is a company that went bankrupt, and my mother-in-law had invested a lot of money in the bonds of DHFL. So there are two types of investments that you can do. For example, there is something called as equity. For example, if you go and buy HUL share or ITC share, you are buying the equity, right? So that is fairly straightforward. But if you go and buy bonds, then it is like doing a fixed deposit. So companies come out with their own bonds. These are called as corporate bonds, and DHFL had come out with its own corporate bond. At the time of buying that bond, my mother-in-law was told by her investment advisor that, you know what, this is like doing a fixed deposit. You will not lose the money, and the rate of return is better than a fixed deposit. So why don't you go and invest? Bad stuff. You should not believe such stories. And this is what I'm going to talk about on today's video, that whenever you see higher returns, there are associated risks with it. So as an investor, you must understand both the return side of the equation and the risk side of the equation. There is absolutely no instrument in the world where people will say that, hey, this instrument is going to help you make 100% returns, better than FD returns, but the risk is lower than FD. No, such an instrument does not exist. But yes, you can make up to 100% return by doing fixed deposits also. I'm going to talk about it on the last section. Now let me talk about three specific points by giving you relevant examples and stories around it. So the first story is about the Squid game token. Now in today's world, there are so many new instruments are coming up. People are promising new things that, you know what, if you come, you use our product, we will give you like 500% return on this particular instrument, come and invest with us. So a lot of novice investors who do not know much about investing, they get lured by such massive promises. It is not correct, right? So let me quickly explain what the story behind the Squid game token is. So all of us know that Squid game is a very popular South Korean series. Lot of traction on Netflix. Netflix made insane amount of money through it. And in the crypto narrative or the crypto world, sometimes really bad actors or bad tokens come out into the picture, which are pure fluff, nothing else. So using this narrative, a Squid game token was released by the developers. It was developed very quickly and released in a very haphazard fashion. And the white paper around it was very shady. What it essentially said was that, hey, if you come and invest in this token, it is going to adhere to a lot of functionalities, a lot of good stuff will come out of it. So come and invest your cryptos into our tokens. So Squid game token was launched on Binance Smart Chain. So something like PancakeSwap, which is a decentralized exchange, listed it. Lot of investors poured their money onto that token, and then rug pull happened. So rug pull simply means that the people who were developing this project, they just abandoned the project and sucked out all the money that had come into that particular project. Now you would say, Akshat, you know what, crypto world is fluff. A lot of scams happen in the crypto world. I'm not a believer in crypto. I understand. So couple of points very quickly I'll touch upon here. First, investing in new cryptos is like investing in a startup. So whenever a new coin comes, please understand the tech behind it. Please understand the entire narrative, value add behind it. Only then go and invest. Otherwise, these type of scams will keep on happening in the crypto market. Now you'll say, Akshat, you did not answer the fact that, hey, crypto is a scam. It is a scam. It is a scam. No, it is not. Let me tell you some counter examples. So have you heard of Sahara Chit Fund? Have you heard of Reliance Com, which is a listed company? The share price literally went to zero. Have you heard of JVG? So JVG was one of the old listed companies in which my grandfather invested money and lost a lot of money. These type of scams happen on listed companies in Indian stock exchanges also. Till the time people build businesses, scams will keep on happening, and you and I as investors need to be sensible not to lose our money. This brings us to the second point of the video, where a lot of people are told about the bond market that, hey, you know what, if you go and invest your money in a fixed deposit, it is 100% safe. Nothing will bad happen to that money. If you go and invest in a corporate bond, returns are so much better than fixed deposit, and there is literally no risk. It is like fixed deposits. Both the narratives are wrong. And here is a small snippet for you that fixed deposits only cover up to 5 lakhs of liability. For example, if you have done a 50 lakh FD with your bank, and if something bad happens with the bank, you will only be reimbursed up to 5 lakh rupees. That's it. On top of that, there are sometimes called as capital control. For example, in Lebanon's case recently, there were capital control issues. For example, you have money lying in your bank and the government comes out with an order that, you know what, you can't withdraw your money. Do whatever you have to. Same type of stuff happened when? During demonetization. Same type of stuff happened with which banks? I would ask all the people to do a little bit of Google search and put out the comments in the comment box. Which banks in India have had this capital control problem? It happened very, very recently also. I'm giving you a hint. So type out your responses. I will personally read through all the answers. So the bottom line is that, again, please don't believe in the narrative that just because something is a bond, which is like an FD, therefore it is exactly like an FD and there is no risk. Even FD is risky, right? So you need to understand this. And this is a very important chart. I will ask my editor to zoom it out so that everyone can see it clearly. I will talk about a few key points on this and talk about an interesting investment opportunity also that you must only take if you understand this particular chart. So from this chart, let me just quickly cover a few key terms. So one is the meaning of a bond. So bond essentially means it's a promise, right? So essentially, if a company or a government launches a bond, it is saying that, you know what, just go take this bond or a piece of paper from us. In return, give us some money and we promise to pay you back a certain sum of money, your principal amount plus rate of interest and other details that are mentioned on it. So bond, what does it simply mean? It simply means that it's a promise. That's it. Nothing fancy. So your question to me would be that, you know what, why is it that people invest in equities? Why don't they just go and invest in bonds? The reason is that equities have generally given higher returns, but they also have higher risk. Bonds generally have less risk. Therefore, the returns are also proportionally lower. Now, there are different types of people. For example, if you're slightly older or if your portfolio is already very aggressive, you are heavily invested in highly volatile stocks and you need little bit of calm, peace, so you go and invest in bond market. There are different types of bonds with different levels of risks and returns. So now let me quickly cover what is meant by secured by collateral loans. So collateral essentially means that, for example, when you're going to a bank to take a loan, you are mortgaging your house. So your collateral is what? The collateral is the house that you are mortgaging, because if you are unable to repay the loan to the bank will come, they will say that, you know what, you had put in the collateral as your house, we are going to sell the house and recover our money. These are collateralized loans. So of course, there is less risk for the bank to give you loans if the loans are collateralized. Similarly, when companies or governments issue bonds, when they are issuing bonds, they can also give out collateralized bonds. So that is the first key thing that you need to understand about bonds. The second key thing that you need to understand about bonds is the bankruptcy remote. Now, bankruptcy remote, it's a fancy word of saying simply this. For example, DHFL as an entity, it was an entire business, it went bankrupt. So everything with it, of the entire entity, everything that they owned, that also went bankrupt. In bankruptcy note, what simply happens is there is a small entity that is carved out within the big business itself. Now, if something happens to the bond, only that entity goes bankrupt, not the entire unit or the entire business. So don't worry about the complexities, just simply understand there is something called as bankruptcy remote. If that is covered under your bond becomes even safer. So by understanding these basic terms, you can understand which bonds are riskier versus which bonds are not, which bonds will pay you higher returns versus not, and you can accordingly pick an instrument that makes sense for you. So in addition to these broad macro points regarding bond investing, you must understand specifics of a bond as well. So here are the specifics of the bond that is going to be launched in India very soon. So the bond is called as NBFC You Grow Capital, and here are the specifics of this bond. So I will read this out to you and help you explain what exactly is this bond doing. So the bond is going to pay out 10.5% XIRR, which is extended internal rate of return. In simple terms, you are going to make 10.5% returns on this particular investment in a year. The interest is going to be paid to you monthly, and the principal amount is going to be paid in 3 parts. So if you ask yourself that, hey, is this bond going to give me more returns than the FD? The answer is yes. Is this bond riskier than an FD? The answer is again yes, because this is a senior secured bond. I will ask my editor to put up the chart again of what senior secured bonds are. This particular bond falls in that category. Now, if you as an investor feel that, you know what, 10.5% return seems very lucrative because A, it is less risky compared to an equity, and B, it gives more returns compared to a fixed deposit, then you can go and invest in this bond. So please make these type of investments only if you understand these basic points that I have talked about on this video so far. This is a good bond that is being launched by WintWealth, therefore I covered this on my video. So give it a go and check it out if it fits with your risk profile. Now comes the third and final section of this video, which is where I will talk about how you can make 100% returns by investing in fixed deposit type of instruments. Can you make up to 100% return by investing in fixed deposit type instruments? The answer is absolutely yes. Is this a scam? No. Are people doing it? Yes. What is that method or technology called? Okay. So this pertains to the world of cryptocurrencies, and you can do something called as yield farming. Y-I-E-L-D farming. So what is yield farming? I'm just simplifying the entire concept for you so that you understand. So let's try to understand it by picking a parallel example. So yield farmers are basically investors. They are called as yield farmers also. Similar to the way we invest in different fixed deposits, they go and invest their money in liquidity pools in cryptocurrencies. So let me talk about the parallel examples. That my goal as an FD investor is to generate the highest percentage of return that I can possibly make. Then what is it that I should be doing? So I should be switching my banks very frequently. For example, if IDFC First is paying me 8.5% on my FD, I will keep my money in IDFC First till the time this interest rate exists. As soon as IDFC First cuts its interest rate, I will move on to depositing my money in some other new bank, for example, AU Small Finance, right? Then whichever bank is offering me the highest interest rate, I will keep on switching my funds. So that is the way you can maximize your FD returns by investing in the physical world right now, which all of us can easily understand. Now you can do something very similar in the crypto world. These yield farmers mostly put their Ethereum, because most of the liquidity pools are governed by Ethereum protocols. So they go and invest their money or put their money or tokens as collaterals in different liquidity pools. So liquidity pools are like different investment instruments that cryptocurrencies have. So you can go and use protocols like Uniswap or PancakeSwap and use the liquidity pool there to stake your tokens like Ethereum. You keep on switching along these liquidity pools to maximize your returns. Now, will you definitely make 100% returns with this strategy in the crypto world? The answer is no. You must be good at switching pools. Second, those liquidity pools need to keep paying you that type of rate of returns. Now, the return rate that these liquidity pools offer, it depends on a bunch of different things, but it definitely depends on the supply and demand of those tokens. Now, if there are not too many people who are there to invest their money in these liquidity pools, then of course the rate of return that these liquidity pools are paying out to you will become much higher, and you will end up making up to 100% returns. So theoretically, yes, you can definitely do it. Does it require skills? Yes, it does require skills. It requires understanding. Therefore, go and educate yourself about yield farming. If you want, I will make a separate detailed video on this topic. It is going to be slightly detailed. But I hope that you understand the narrative that in the crypto world, by doing yield farming, you can actually make up to 100% return by investing your money in liquidity pools and by switching around different liquidity pools. I said liquidity pools too many times. But the central message of this video is fairly simple, that please understand the risk, please understand the reward. Sometimes people will tell you that, you know what, that this instrument has no risk whatsoever. Please don't believe it. All the investment instruments have different varying levels of risk. So you need to pick your level of risk. Similarly, there needs to be an associated return in conjunction with the risk that you are taking. For example, we started out by talking about the Squid Games token. Now that particular token had a lot of risk, so the rewards also had to match with that. Only then you should have invested your money in such a thing, if at all. Similarly, if you are going and investing your money in an FD, please understand that you are taking very limited risk, therefore your returns are also going to be lower. In between these two extremes, we have bonds and equity market, and within bonds, these are great instruments. You again need to understand the different narratives that are going on. I tried to explain a highly complex topic in a simple language. I hope you liked it. Please press the like button, and I will see you the next time, and check the link in the description box.